Okay, we still have a few more people jumping in, but we can go ahead and get started. Appreciate everybody joining today. We'll continue to admit people as they show up to the meeting. My name is Scott Mastley. I'm the CHRO for Thread. We are a payroll and HR provider. I see that some of our clients are on there and some other folks would love to get to know. So thanks for joining us today. This is just part of our ongoing educational series where we like to reach out to the community and keep you up to date on whatever is relevant at the time. And right now, what seems to be most relevant for a lot of our clients is the specifics of the tax and overtime provisions of what people have called OBA or the Big Beautiful Bill. And that Big Beautiful Bill is what it is described as, big. So we're not going to cover all of that today, but we are going to hit specifically the overtime and tip related components of that so you know what you need to do, what's relevant for you, and then we'll talk a little bit about what we are doing as well. So I am honored to introduce you to Peter Spanos, who is a principal at Offit Kurman. Peter is a partner of ours. They work with several of our clients and have helped us a lot. And Peter has over 4 decades of nationwide, full spectrum employment law and labor law experience, helping employers of all sizes across multiple industries. So he is a great resource for us to have, and we're excited to have him. Thank you, Peter.
Thank you, Scott, and welcome everyone. I hear a few more dings, so I'm going to hold up for just a minute um, until the people being admitted stop dinging, and we'll go ahead. Let me introduce today's topic by saying that the HR1, otherwise known as the One Big Beautiful Bill, or BBB, depending on how you like to say it, has more than 700 different titles on the table of contents of the bill. We're covering two. So there's a great deal to the Big Beautiful Bill, but much of it doesn't have to do with employers. The other thing to understand at the very beginning is that the employment laws we'll be talking about today are actually tax laws. And therefore, we have to have a tax law perspective, both on behalf of the company and on behalf of your employees. Because what we're really dealing with is changes to the tax law, not changes to the employment laws. Now, we'll be talking about the employment practices that may be generated by these tax changes. Some good, some perhaps not so good. But bear in mind that what we're talking about is really a variant of personal tax law, not necessarily company tax law, although will have obligations. So, well, let's go ahead and get started, and we will proceed. So, HR1 was signed into law on July 4th. The significance of that is that the regulations that implement this law, and of course, being a tax law, it lives and breathes on the regulations that the IRS puts into place after the law is passed. So that was signed into law on July 4th. So that means that the agencies have, especially the IRS, have roughly until the early October to enlighten us as to what the regulations will actually say. What we're going to talk about today is an analysis of what the bill definitely says and what you need to do as takeaways as employers with the bill, and going from there. Now, in terms of the timing of the bill, there's one other key point, and that is this bill is temporary. It takes effect starting with this current tax year, which is somewhat unusual because normally we have a little bit of a gap while the regulations are being issued before a tax law takes effect. It's more common in employment law to have something take effect immediately. It does not apply retroactively to the 2024 or earlier tax years, but it only applies to the 2025, 26, 27, and 28 tax years. After that, it will be up to Congress, whatever the Congress is at that time, to determine if this continues or does not continue, or is expanded or not. So here's the first thing that you need to know. With regard to tip income and overtime compensation, HR1 creates a deduction from adjusted gross income for the taxpayer, that is your employee, that is subject to some very detailed rules, but it is a type of tax adjustment that applies both to itemizing and non-itemizing taxpayers. It's what's called an above the line deduction. That is, it reduces gross income. Let's begin with the tax on overtime, or no tax on overtime. Now, the slogan in the media is no tax on overtime. Well, that's not completely accurate because as you'll see, there is overtime compensation that is still taxed regardless of this bill. What we have is a tax deduction from adjusted gross income for federal overtime compensation. Section 70202 of the Act allows employees to deduct from their federal tax income up to $12,500 in overtime compensation of the kind that is payable under the Fair Labor Standards Act. If the taxpayer is a joint filer with, say, his or her spouse, then that deduction goes up to $25,000 for both taxpayers. So if they're both employed, each gets about $12,000. Now, many employers are trying to rethink how overtime is classified and compensated as a result of this law. There may be some employee pressure or questions trying to determine how overtime is classified and compensated. My advice throughout this presentation is to go slow on this, and you'll see why as we go through this. The key to understanding the changes that are made to the overtime compensation law is to understand what is qualified overtime compensation. This law only affects qualified overtime compensation. So we have to thoroughly understand what is qualified overtime compensation. First of all, the deduction can only be made for overtime required under the Fair Labor Standards Act. This is the typical 1.5 times pay for hours over 40 per week. As we'll see, other kinds of overtime do not fall within this overtime compensation deduction. The deduction only applies, and this is a very key point, to the premium on overtime, not to the regular wage amount that's included in overtime. In other words, the deduction only applies to the half part of time and a half. So if I'm working 42 hours in a week and I make $25 an hour, my deduction is only $25 because it's only the 50% of the 2 overtime hours, which is $12.50 per the 2 overtime hours. So my deduction's only $25, not the full amount of overtime that I get for the 2 hours of overtime work in addition to the 40. Now let's try to understand what is qualified overtime compensation. Number one, it only applies to federally mandated overtime. So for example, in the multiple states that have additional overtime rules, such as California, there's about 5 states which have state mandated overtime. For example, California has a statute which mandates some daily overtime. Overtime required by state law that is not absolutely coincident with overtime as required by the Federal Fair Labor Standards Act is not covered by this law and is fully taxable. So one of the things that employers need to realize is that from now on in tax reporting, we're going to have to separate out the overtime premium under federal law from the taxable income through overtime under federal and state law for regular pay and state law for all overtime. This is really the biggest complication of HR1's overtime rule, is that it doesn't reach all of overtime by any stretch of the imagination. Now let's also talk about another aspect of qualified overtime compensation. And that is, it does not apply to what the statute calls voluntary overtime. Voluntary overtime is what the employer agrees to do that is not actually required by the Fair Labor Standards Act. For the biggest example here is, it's typical under collective bargaining agreements for unions to obtain an agreement that certain times have double time of overtime. Very often it'd be weekends or Sundays where they might get time and a half during the week, and they get double time on Sundays, Saturdays, holidays, and so on. Overtime in excess of time and a half for 40 hours per week is not covered under this law. It is fully taxable. That is considered voluntary overtime, not Fair Labor Standards Act overtime. So if you have a collective bargaining agreement, and that collective bargaining agreement addresses overtime that is different from time and a half after 40 hours a week, providing for overtime under special occasions or whatever, or for that matter, providing for overtime where you may work in excess of 8 hours a day. That's again a common provision in collective bargaining agreements. Anything other than overtime after 40 hours a week at time and a half is not covered by this law and remains fully taxable. So in addition to the state law separate tracking that you have to do in those 5 or 6 states that have those laws, under any state where you have a collective bargaining agreement, you also have to separately track what is mandated by the collective bargaining agreement and what is mandated by HR1. In addition to that, some companies have greater overtime for certain situations than is actually required by the Fair Labor Standards Act. This is not as uncommon, but if you have that, that kind of overtime is not covered by HR1. Again, that has to be separately tracked and separately handled. The other exception from qualified overtime compensation is tax deductions that are already claimed. Under this law, for example, if the employee is entitled to take a tip deduction, the employee cannot also take an overtime deduction for the same compensation. You can't get 2 federal deductions out of one, can't ever do that. So one of the things that is in this law is if you have a deduction for any other reason that you can claim, you cannot claim an additional deduction for that overtime. So to recap, under HR1, non-taxable overtime is only a portion of all the overtime out there in the real world, and it requires separate tracking. You have to determine, and one of the key things we'll be talking about is you have to determine what is qualified overtime compensation for purposes of HR1. Again, let's review the federal and state overtime differences.
Peter, can I clarify real quick?
Sure.
On that last one, just want to make sure I heard that correctly. So if they're taking a deduction for the tips, then they cannot also claim the overtime. But if they're taking the overtime, they cannot claim the tips?
It doesn't work the other way around.
Only for tips towards overtime.
That's right. That's
Okay.
right. But in compliance with tax law in general, you can't deduct the same thing twice or take it off as an adjustment twice. So the taxpayer needs to be careful about that. Okay.
Thank you.
So again, it's important to know the differences between state overtime and federal overtime. In most states, it's the same thing, but qualified overtime under this statute is only the overtime compensation premium, the half of time and a half, that part, paid in accordance with the Fair Labor Standards Act. So that is only overtime after 40 hours of work per week. If your overtime schedule in your business pays earlier than that, or later than that, or in addition to that, it is not covered by this law. California, Colorado, Alaska, Nevada, and Oregon have daily overtime requirements. These are not qualified overtime under H.R. 1, and the taxpayer, the employee, must pay full taxes on those. That's going to mandate, as I said, that you separately track state overtime and federal overtime, and then separately track qualified overtime. As employers, you need to establish procedures for separately recording Fair Labor Standards Act weekly overtime from any other kind of overtime compensation, whether it's under a collective bargaining agreement or whether it's under your state law. You're going to be separately tracking qualified overtime as a unique concept now. That has to show up in all your payroll records. Now, as employers, one of your primary concerns is going to be the reporting requirements for this kind of compensation so that your employees, the taxpayers, can handle it properly on their tax returns. The law is clear. You have to separately report qualified overtime compensation on a Form W-2 or Form 1099. The law also provides for self-reporting especially on tips, if employees can do it in their forms for that. But as the employer, you have to separate out qualified overtime compensation under the definitions we've been discussing, and then report those back to the employee on Form W-2 or Form 1099. Now, as I said, the regulations are not out yet. So there is no form. There is no modification to a W-2 or 1099 form yet, and the IRS is charged with that responsibility. For that reason, the statute does say that for the current tax year, you can approximate what is qualified overtime compensation by any reasonable method. You're not held to a strict standard of being able to isolate every dollar. That the standards for isolating and reporting qualified overtime compensation will be defined by the IRS starting sometime in early October. But for now, if you want to do an approximation of it as you go along to get ready, that's okay. But bear in mind that you won't really know how this is going to work until after the first part of October. Now, one of the things that I want to especially cover is whether or not this requires or permits or is even advisable to change your pay practices. What I'm going to tell you today is that at this point in time, until the regulations are issued, you're running compliance risks if you attempt to change your compensation practices because of this new treatment of tax deductibility of some kinds of overtime. I have a couple of examples here that are purely hypothetical. I'm positive no one else in this presentation is doing this, but just as examples. Let's say that you have exempt employees or salaried who want to take a tax advantage somehow by claiming part of their pay as overtime. Obviously, they can't do it without your cooperation. So maybe you would get pressure to reclassify them as non-exempt, lower their base pay, and put in some of those excess working hours that they put in as exempt employees as overtime hours. Well, that would violate the tax laws and the employment laws in numerous ways. It would not only violate the Fair Labor Standards Act, um, but it would also not meet the definition of qualified overtime. So no one is going to be able to reconstruct their salary or pay in order to take advantage of the overtime deduction. They either have it now or they don't. Secondly, people might be tempted to say, well, perhaps what we ought to do is I'll reduce my regular hours and I'll put more hours onto overtime and thereby get a bigger tax deduction. Again, this is not going to work because the only overtime that's deductible is that currently is mandated by the Fair Labor Standards Act, which is hours worked after 40-hour per work week. So creating artificial overtime, such as, for example, saying it's a 30-hour work week or 35-hour work week, or applying bonuses for overtime, anything like that, that is not going to work. The IRS, the Treasury, is going to issue regulations that will probably address various forms of misuse and reclassifications that are not supposed to work. The thing to realize is all of the practices on which this is based are kind of frozen in place as of July 2025. And things that you may want to creatively do, or that your employees may want you to creatively do going forward, those are very unlikely to work, and they're very likely to be compliance risks. The best thing to do, again, is to not change any of your pay practices. Get in a position to separately track that one component of qualified overtime under the federal law of HR1, and then refine that as necessary when the regulations come out, and don't do anything else. Okay, having covered overtime, let's talk about the no tax on tips. Again, the slogan for this does not really cover the reality. It's not that we don't have any tax on tips. It's that we have a certain amount of deduction from adjusted gross income for qualifying tip income. And just like with overtime, the key is not whether it's a tip or not. The key is whether it's qualifying tip income. And that's the concept that you need to understand. One of the basic things that needs to be understood about this law of HR1 is that there was a very specific target of the legislation. This deduction is intended to benefit restaurant employees, hospitality employees, service industry workers, who before the end of the year in 2024 were in occupations that typically did receive voluntary, non-negotiated, non-mandatory, free will tips. That's a qualifying tip income. And again, this is not intended to change anyone's practices or to permit change. It is intended simply to have a tax effect on those professions, those occupations that typically receive those kinds of voluntary tips from customers and no one else. Again, it's going to be popular with employees and for that matter with independent contractors. And so you need to consider compliance, restrictions, and problems. So let's talk about what are qualified tips. That's the only thing that the taxpayer, the employee, can deduct. First of all, qualified tips must be voluntary. If your company has input into the calculation of the tips, or assesses tips in some mandatory way, such as, for example, in a restaurant, a large party automatic service charge of some kind. Or for that matter, if it's the practice to kind of work with the customer to determine a tip, none of that's going to qualify. The only thing that is a qualified tip is whatever the customer voluntarily pays without prompting from the establishment. Now, that doesn't mean that you can't use a program that tells the customer, well, here's what 20% is, here's what 15% is, and so on, as you commonly see in a register tape or a handheld device or something like that. But it does mean that your employees, the taxpayers, will not be able to deduct tips that are mandated by your policies. They have to be voluntarily paid by customers. The second key point is that those tips have to be paid in cash or by credit card. In other words, they're immediate transactions. And if they're paid through tip sharing, the tip sharing arrangements have to meet the other requirements of tip sharing under the Fair Labor Standards Act, most salient of which is that you cannot share tips with non-service employees. You can share tips with bartenders and so on, but you can't share tips with managers or supervisors. So one of the things that you'll want to do is to go through your tip sharing arrangements and make sure that they comply with the other tip sharing rules. And then, as I said before, there's an occupational requirement. Even if voluntary tips are received in cash or by credit card or through tip sharing, they have to be in a qualifying occupation that customarily and regularly receive tips as of December 31, 2024. And that will be further defined as this law is implemented. The IRS is going to publish a definitive list of qualifying occupations in early October. It will likely be very limited to traditional tipped occupations. We don't know exactly what it will be, but that actually will tell us what is a qualified tip deduction. We already know that occupations that are not historically tipped occupations, such as law, accounting, finance, consulting, performing arts, are excluded from eligibility for the tip deduction in the statute itself. So again, the most important definition should come out in October, but unless your employees are in a historically typically tipped profession for voluntary tips, this doesn't apply to your company or your employees. And furthermore, you can't create a new tip arrangement to take advantage of this law. You've got to have the historical one in place already. The deduction phases out in $100 increments per $1,000 of tip after $150,000 in adjusted gross income or $300,000 for joint returns. That's a lot of tips. I don't think many people run into that issue. Now, with respect to the deduction for tips, what are employers required to report? When you issue a W-2 or a 1099, the employer must report total cash voluntary tips. That means that you have to report not only the tips that go through your system as credit cards, charges, and so forth, but you also have to do a better job of enforcing tip reporting for employees that get cash tips. Whether the tips are paid in cash and tracked by the employer or not, all tips that qualify for this deduction have to be reported on the W-2 or the Form 1099. There's also, of course, an option for tipped employees to self-report, on a Form 4300 type form where they can voluntarily disclose it, where they're trying to claim, for example, Social Security. But all voluntary cash or credit card tips must be reported now on W-2 or Form 1099, and that means you have to collect that information. The second thing that has to go on the Form W-2 or 1099 is the qualifying occupation. We don't know how that will actually look, but the employee's participation in a qualifying occupation, an occupation that traditionally received voluntary tips up to and through December 31, 2024, that will have to be reported so that the Treasury knows that the employee is in a qualifying occupation. That's going to become part of the reporting obligation. So, are there any risk considerations on the tip deduction? Well, certainly any mischaracterization of wages as tips to try to expand the tip deduction is going to be a problem for the company and for the taxpayer. For that reason, you don't want to try to adjust your tip practices except to bring them in line with the tip employee requirements of the Fair Labor Standards Act as they already exist. You can, if you want to, change your tip pooling arrangements. It may be simpler now to adjust your tip pooling, and especially if your tip pooling involves any kind of sharing in the pooling by administrators, supervisors, owners of the business, or other non-tipped occupations, you may want to consider revising that tip pooling arrangement. You also probably would be doing a big favor to your employees, the taxpayers, if from now on you don't have mandatory tips in the customer transaction. If you do have those mandatory tips, the mandatory service charges or things like that, say for large parties in a restaurant, you probably are jeopardizing the tip deduction, and you may want to just track voluntary tips instead. That's not to mean that you can't suggest things in terms of providing a chart or a rundown so that your customers can make a tip choice. But you don't want to negotiate. You don't want to approach your customer and say, we always charge 20% for your large party. Or, for this kind of service, we really strongly advise you to tip, $10 or something like that. You want the tip to be voluntary. And we don't know what the Treasury will say is the hallmark of voluntarism, but you do want to stay away from anything that tells the customer what to do as far as the tip. It has to be voluntary. And then the other thing is be sure that 100% of tips in cash, as well as tips in credit cards, which of course you'll report, is enforced. The employees have to turn in and report the tips so that you can report it to them on the W-2. Again, as with overtime, our advice is to not change your policies except with respect to the tip reporting and the compliance with tip pooling rules at this time, at least until we see the regulations. So, as a practical matter, this is a law that benefits the employee, but creates a lot of headaches for the employer, as you know. You therefore want to proceed with caution, and this is not a good time for creativity. Now, what has not changed under HR 1, under the rules? As I said before, first, nothing in this excuse me. Nothing in this bill affects anything except federal taxes. State taxes and local income taxes on overtime and tips must still be paid. Second, Social Security, Medicare, and unemployment taxes fully apply and are not changed. That's going to complicate the structure of tax returns. But the full amount of compensation is still subject to Social Security, Medicare, and unemployment taxes. Now, those taxes, some of them are computed based on adjusted gross income and some are computed based on gross income. Those complications will hopefully be addressed in the near future. But nothing in here says that you can't have to pay Social Security or Medicare taxes or unemployment taxes on the full amount of your gross income. So let's kind of summarize and walk through what we are suggesting you do now. First of all, don't rush out and change your compensation structure. This is not an opportunity to be creative. Number two, wait for the Treasury regulations, especially the occupation list for tip eligibility. Number three, make sure that your wage and hour tracking is accurate and that you're tracking the right things at this time. Make a reasonable effort to track qualified overtime and to collect the full amount of qualified tips that employees receive. Continue to carefully document the regular rate of non-exempt employees and their hours. Carefully track those. I know you're already doing that, but under this new law, that careful tracking of the exact hours and their regular rate is going to be even more important to accurately do the reporting. One thing we do recommend at this time is go ahead and audit your tip pool arrangements and make sure that they're in compliance with the FLSA and that they're not depriving your employees of the opportunity to deduct qualified tips. Prepare to update your payroll systems, and that's more like being at the starting line ready to go in October. I have not yet seen any of the payroll companies update their systems for this, but you can be sure that they will very quickly starting in October. And both your payroll provider or yourself, if you're your own payroll provider, and your CPA support will have to take a look at what are needed in terms of the modifications to your W-2s and 1099s. Those will have to be reconfigured. So, Scott,
Yes, sir.
what is the role of thread in all of this?
Yeah, good question. Thanks for teeing me up. For anyone who is currently a Thread client and is using iSolved as your payroll platform of choice, just want to let you know what we're doing. Obviously, we're waiting as well for some of these final regulations. Anytime there's a change in a form, like we need a new box on a W-2, which means we might need to create a new earnings code to track along the way, we will do that once that's finalized. We don't want to make these big sweeping changes in the software before anything is final, because then they will change it again at the last minute and and it jacks everybody up. So we want to make sure you know that we are paying attention to that, and we will update software, forms, W-2s, tracking, anything as needed once this comes out. For now, I would say continue to track all of your time, including overtime worked. iSolved is also capable of capturing your tips. You can create earnings codes for that. So continue to track your tips, and we will keep you updated as well. Some of our clients have said, what should we be telling our employees right now? And we're going to get to a few more questions in just a minute. But for now, if it were me, I would be telling my hourly employees, this only applies to the federal tax portion of your overtime, not the entire overtime. And then sometimes I've had clients say, what happens when an employee comes up and says, oh, actually, I forgot to report all of my tips last month or 3 months ago, and I want to add those now. What do I do? Well, that may be a judgment call on your part. Peter may have a different answer for that, but just a reminder that it's not legal for people to not report their tips. Obviously, anybody who's ever waited tables or bartended knows that that goes on all the time. But as an employer, you got to do your best to capture the tips that are paid out, track them in the system so that they are taxable appropriately. And Yeah, just want to let you know that we're here for you with Thread, and I got some questions for Peter if you're ready.
Let's go ahead.
Okay. I got one question that says, if a receipt displays the phrase suggested gratuity followed by a range, is the tip still considered voluntary?
We don't know for sure because the regulations have not come out. I'll tell you my view of it right now, which could change if the IRS changes it for me. I would say that allowing on the register calculations to make it easy for the customer to do math should be okay because that's voluntary. But you want to avoid language that suggests a mandate. So in an ideal world, I would prefer to see a register that says, for assistance in calculating voluntary tips, here's a chart or something like that. Use the
Okay.
word voluntary as opposed to suggested.
Well, as an English major, I like it when they do the math for me and it just says, 10%, 15, 20% like that. It makes it easy for me. And I think what Peter's saying is that's okay as long as it doesn't uh, imply that you need to be paying one of these or that one of these will be automatically added. Another person asked, what if you have a mandatory gratuity for groups over 8 in a restaurant?
That is not a qualified tip.
Okay.
And those tips will be fully taxable. Obviously, you're going to report them because it's going to come through on your system. So you should consider changing that to allow your employees to take advantage of the tip deduction on those tips.
Okay. A few clarifying questions. You mentioned the tip applies to the overtime premium. So tell me if I'm correct
The
here.
deduction applies to overtime
The
premium.
deduction, yeah. So regular rate of pay is $10 an hour, and this is where I'm talking about overtime. $10 an hour. The overtime rate is $15 an hour. So that deduction only applies to that $5,
That's
not,
correct.
not the 15. So you're not
Not the
getting a
50.
deduction on the full overtime pay. It's just the difference between the regular rate and the overtime rate.
That's correct. And that's maybe the biggest misleading thing about the no tax on overtime phrase is it's not really no tax on overtime. There's definitely tax on overtime hours. What it is there's no additional tax on the overtime premium under the Fair Labor Standards Act.
Okay, great. And then also, if people do try to claim retro tips, if you do enter those, you do need to know that that could draw a little attention to you, potentially as an employer in the way you're tracking tips, but also you would have to let employees know that they are going to have to go back and still pay Social Security, Medicare, state, and local taxes on any of those tips that they're reporting after the fact. I have another question that says, is there
That's a
any?
very good point, Scott, that
Yeah.
that they're not simply putting a free deduction in the system. And also remember that you have to, in the situation you described, you have to be sure that you're not committing two violations instead of one. One violation is the employee failing to report all their tips. The other violation is over-reporting, in the past because you don't really have a way of checking it. So you want to make sure that in that process you're fair and do report things after you're reported, but you also have to make sure you're not allowing a loophole that lets people take advantage of it that they're not supposed to.
Exactly. I have a clarification on holiday pay, or I know you mentioned this as voluntary pay earlier. So if a company says if you work on a holiday, we'll pay you 2 times your regular rate, does that apply to this?
No, that is not qualified overtime. That is fully taxable because it's not mandated by the Fair Labor Standards Act. It's an employer's voluntary policy. So it is not qualified overtime.
Okay. And is there any indication that states will follow suit with these laws?
I would say that there isn't a lot of information about there, but I would hazard a guess that the states in which taxes are the biggest problem and the most burdensome are going to be the last ones to consider this.
Okay.
I confidently predict, first of all, that if states do address this separately, they're going to be different answers. I think that states that track overtime compensation, let's talk about overtime first. States that track overtime compensation and have the same system as the Fair Labor Standards Act, they're unlikely to do anything um, because they're eliminating a source of revenue. So there may be some states where eliminating that source of revenue is okay, but it's very unlikely that most states will want to do that. In states that have their own overtime, I think they're wedded to a different program anyway, and it's very unlikely that they will change. And those coincidentally, if you notice the list of states, include some of the states with the biggest burden of tax anyway.
Right. Okay. Here's another question about for states that require daily overtime. For example, at the end of the week, the last day of the pay period, the state says if you work over 8 hours a day, it's overtime. They work 10 hours that day. Their total hours for that week is 42 hours. So does this deduction for overtime still only apply to those 2 hours because that's over 40 and that's all that's required under federal law?
That's right. In that particular hypothetical situation, you have 2 hours of qualified overtime.
Okay, great. Let me see if I have any other questions here. I'm looking on the list. Now's your opportunity, everybody. I see y'all been putting some in one. Feel free to add some more questions if you want to. What about valets? Can we talk about any specific positions, or is the answer we only know what they've told us and we'll wait for the rest?
Well, for all positions that are going to qualify for the tip deduction, we have to wait for the qualified occupation list. I think it's reasonable to expect that parking valets, bellmen at hotels, and some of those other occupations will be included on the list. If you feel like you want to have input, now's the time to work some information to the IRS and point out that the bellman at your hotel typically receives tips and always has for decades, if you want to preserve that, because that's what they're going to try to decide. I think in those occupations where people normally expect to pay tips, it's likely that there'll be a tip deduction, but you will never know until October.
Okay, I have a question. I might need a little extra here to understand exactly what it's saying. It says I have clients that request a gratuity on their account. Would that be mandatory?
Well, if they're requesting that the gratuity be placed on their billing account as opposed to paid in cash, that's probably going to qualify as tipped income if all the other things are met. The method of payment is not as critical. It's the reason for payment that you want to focus on. So if the reason for payment and putting it on the bill is somehow a mandatory thing for the enterprise or the business, it's not going to be qualified tip income. But if the reason for putting in the bill is convenience of collection of the money, I don't think that interferes with it being qualified tip income.
All right, thank you. Then I have a question about Thread and iSolve users W-2s. I said, I know you mentioned they will be adjusted. Do you anticipate the box created for qualified overtime to only contain the premium portion of the full amount? I would just say whatever we are required to report as employers, that's what will be there. So I don't want to commit to exactly what it's going to look like, but when they tell us what needs to be in that box and what satisfies that requirement, that will be there.
Yeah, and let me, without attempting to pin down Scott or Thread in any way,
Mhm.
it's probably the intent of the law that the qualified overtime, that is that part of the premium that's FLSA premium, and that one half of the hour, it's probably the intent that that gets reported separately as a unique number.
Yeah, yeah, I agree. Another question, are we looking at overtime for all of 2025 or starting in July when this was passed or starting in October when regulations are finalized?
This applies to all of 2025 tax year. And individuals have a calendar tax year. This is a taxpayer level tax change. So it applies to calendar year 2025 in total.
Okay. All right. Well, I think that is all the questions we've received up to this point. I really appreciate your time today, Peter, and for everybody jumping on. This session is being recorded. There will be a link sent in the follow-up email. Barb, our incredible marketing director, will follow up with all of you. And if anybody needs that SHRM credit, she will follow up with that as well as the link to this recording, which will be on our website, along with all of our other previous webinars. And as always, if any payroll or HR help, reach out to us. Any employment law representation or assistance you need, feel free to follow up with Peter and Offit Kurman, and we are here to help. So y'all have a great day.
And thank you everyone for your attendance. I hope it's been helpful.
All right. See y'all later.